All right, let's talk about something that's a real game changer in the world of investing. We're going to explore how you can stop just being a depositor at a bank and start thinking like the bank itself. We're diving deep into private credit, a corner of the financial world where things are getting seriously interesting. Ready? Let's get into it. So let's start with this question because it's at the absolute heart of everything we're talking about today. Think about your own savings account. You put money in, and if you're lucky, you get what, 1%, maybe? Then the bank takes your money, turns right around, and lends it to a business for 10%. That gap, that 9-point difference, that's the bank's entire business model. But what if? What if you could step into their shoes and capture that juicy spread for yourself? And this is it. This is the banker's simple secret. And honestly, it's been the same for centuries. It's not some complex Wall Street formula. It's just this: borrow low, lend high. They pay you a tiny bit for your cash, lend it out for a lot more, and live off that difference. They call it the spread. For the longest time, though, getting on the lending side of that equation was pretty much impossible for everyday people. But that has started to change. So, you're probably asking, okay, why is this opportunity even a thing? How did this door suddenly swing open? Well, it's a fascinating story, really. It all started because the big traditional banks, the ones you see on every street corner, they started to back away from a certain kind of lending. And in doing so, they left a massive gap in the market. Okay, let's walk through this timeline because it's how we got here. It really kicks off after the 2008 financial crisis. All these new regulations came in that made it way more difficult and less profitable for big banks to lend to smaller, mid-sized businesses. At the exact same time, we had a decade of crazy low interest rates. That forced huge investors, like pension funds, to go hunting for better returns. They just weren't making enough from plain old bonds. So you've got this perfect storm. Banks are pulling back, and big money is desperately looking for a new home. This created a huge void for thousands of perfectly good businesses. And you know what they say about nature abhorring a vacuum? Well, finance is the same way. Stepping right into that void was a whole new category of player: the private lenders. These are not your typical banks. We're talking about specialized investment funds, shadow banks, if you will, that saw this massive opportunity. They realized they could connect the capital from those yield-hungry investors directly with the mid-sized companies that needed it. They effectively became the new banks for the middle of the economy. Okay, so you're probably thinking, this all sounds like a game for giant institutions and hedge funds. How does a regular person like me get a piece of the action? Well, there is a gateway. There's a special kind of company that lets you do just that. It's called a business development company, or for short, a BDC. This is your main entry point into the world of private credit. All right, let's pull back the curtain on these BDCs and see how they actually work. The easiest way to think about a BDC is like a publicly traded investment fund that holds a portfolio of loans instead of stocks. You can buy and sell shares in it on the stock market, just like you would with any other company. And when you do, you instantly become a part owner of all the loans it's made to maybe dozens or even hundreds of different businesses. So, who are these companies on the receiving end of these loans? Well, they're not brand new startups, and they're not giant corporations like Apple or Amazon. They're the businesses stuck in the middle. See, a lot of big-time investors can't even bother with companies smaller than $1 billion. So that leaves this huge, overlooked playing field. BDCs focus right there. They lend to companies in kind of unsexy industries that others might ignore, firms that need cash to grow their business, or, and this is crucial, to refinance their old debt. These are the nuts and bolts companies that are the real engines of our economy. And that's why this is so important. This quote just nails it. The economy really does work like a machine, and credit is the oil that keeps the gears turning. By providing that credit to the middle market, BDCs are literally fueling economic growth. The availability of that money is often the difference between an economy that's expanding and one that's grinding to a halt. Now, here is where it gets really interesting for you as an investor, especially in an environment with rising interest rates like we've seen. You see, the vast majority of loans that BDCs make have this special feature, a kind of superpower that can be a massive, massive advantage. Let's break it down. You've got two basic types of loans. There's a fixed rate loan, like a classic mortgage, where the rate is locked in forever. If rates go up in the economy, the borrower is thrilled because their payment doesn't change. But then there are floating rate loans, and with these, the interest rate actually adjusts. And here's the key: when market rates go up, the interest payment the borrower has to make also goes up. This is fantastic news if you're the lender. So how does this magic work? Well, the formula is actually pretty simple. You start with a benchmark rate, something like SOFR, which basically just tracks the general level of interest rates out there. Then you add on top of that what's called a spread. That's a fixed percentage that's based on how risky the borrower is. Put them together, and that's the total interest rate. So when the Fed raises rates and that benchmark goes up, bingo, the total interest you're collecting as the lender goes up right along with it. And this chart just lays it out perfectly. It's a direct one-to-one relationship. As interest rates climb, the income flowing into the BDC from all its loans climbs too. This is the complete opposite of what happens to most other investments, like bonds, which get crushed when rates rise. BDCs can actually thrive in that environment, which can mean more profits and bigger dividends for shareholders. Okay, so far this all sounds pretty amazing, right? High yields that go up with interest rates? What's not to love? But, and this is a very big but, being the bank isn't just about collecting checks. It also means you take on the risk. And there is one risk that's so big, it's what keeps bankers up at night. Let's talk about the nightmare scenario. Yeah, time for the brutal truth. We've talked about the opportunity. We've talked about the clever mechanics. But being a lender isn't just a one-way street of collecting interest. Now we have to talk about what happens when the people who owe you money can't pay you back. Look, the single biggest risk here, by a mile, is not that interest rates might fall. The number one risk is default. That's the scariest word in a lender's dictionary. It's when the borrower just stops paying. And when the economy hits a rough patch or goes into a recession, these mid-sized companies are often the most vulnerable. They don't have the giant piles of cash that big corporations do. When their customers pull back, their revenue can dry up in a heartbeat, and suddenly they can't make that loan payment. And this is where it can get really nasty really fast. This quote highlights a terrifying feedback loop. See, most companies don't actually pay off their debt entirely. They just roll it over by taking out a new loan to pay off the old one. But what happens in a recession? Credit markets freeze up. And if a perfectly good company can't get a new loan, they can be forced into default, even if their business is still okay. The lack of credit itself can cause the collapse. So if you're going to think like a banker, you have to analyze risk like one. You have to look past the sexy high yield and really kick the tires on the companies in a BDC's portfolio. You've got to ask the tough questions. How much debt are they already carrying? Can their profits actually cover their interest payments, and by how much? And you have to look at the loan covenants, the fine print. How much wiggle room do they have before they're in trouble? This is the deep dive work that good BDC managers do to protect their investors' capital. And really, this slide sums up the entire trade-off. The banker's dream is simple. You've got a portfolio of healthy, thriving companies, and you're just sitting back collecting a high and rising stream of income. The nightmare? A bad recession hits, defaults start to cascade like dominoes, and your principal investment gets wiped out, erasing years and years of those income payments. And that brings us right back to the beginning. We've seen the opportunity created when the big banks walked away. We understand how BDCs work and the power of their floating rate loans, but we've also looked right into the eyes of the biggest risk, default. The opportunity is to capture the banker's spread. The challenge is managing the banker's risk. So now that you've seen both sides of the coin, the real question is, are you ready to think like a banker?